Hello everyone, and welcome to today's deep dive into two critical financial instruments that play a pivotal role in international trade and finance: counter guarantees and standby letter of credit. Whether you are a student, a finance professional, or a business owner dealing with international transactions, understanding the difference between these instruments can be essential for managing risk effectively. First, let's talk about standby letter of credit. A standby letter of credit is a guarantee issued by a bank, often used in international trade or large projects, where a bank guarantees payment to the beneficiary in case the applicant fails to fulfill contractual obligations. Confirmed standby letter of credit. Now let's introduce an important concept: the confirmed standby letter of credit. In this setup, an issuing bank provides a standby letter of credit to the beneficiary. The key point here is that a second bank, known as the confirming bank, steps in to guarantee the issuing bank's obligation. This confirmation ensures that if the issuing bank fails to pay, the confirming bank will fulfill the payment. Now let's see how the confirmation process works. Here is how it works. The beneficiary submit a demand to the confirming bank. The confirming bank will review a demand to ensure it complies with the terms of the letter of credit. If everything checks out, the confirming bank pays the beneficiary and seeks reimbursement from the issuing bank. On the other hand, the equivalent structure of the world of demand guarantees is not a confirmed guarantee, but rather a counter guarantee. This is a critical distinction. Let's unpack what this means. Indirect guarantees and counter guarantees. In an indirect guarantee structure, there are two guarantees. The first is the counter guarantee issued by the counter guarantor to the guarantor. The second is the demand guarantee issued by the guarantor to the beneficiary. Unlike a confirmed standby letter of credit, these are two separate instruments with different terms and potentially different rules and legal jurisdiction. So, how does it work in practice? The beneficiary submits a demand to the guarantor, just as with a standby letter of credit. The guarantor checks if the demand complies with the terms of the demand guarantee. If it does, the guarantor pays the beneficiary. However, unlike a confirming bank, the guarantor does not have an automatic right to reimburse. Instead, they must present a separate demand under the counter guarantee to the counter guarantor, which must also comply with the terms of the counter guarantee. Key differences between confirmed standby letter of credit and counter guarantees. Let's break down the major differences between these two structures. If a confirming bank defaults, the beneficiary under a standby letter of credit can go directly to the issuing bank and demand payment. In contrast, under counter guarantee structure, if the guarantor defaults, the beneficiary has no right to approach the counter guarantor. This makes the structure of standby letter of credit more secure for beneficiaries, while demand guarantees introduce a higher level of complexity and risk. Direct guarantees with advising parties. There is also another variation we need to be aware of: a direct guarantee with an advising party. In this structure, the advising party, usually a bank, passes on the test of the guarantee to the beneficiary. However, unlike in a confirmed standby letter of credit, the advising party does not assume any responsibility for payment. The legal obligation to pay the demand guarantee rests solely with the guarantor. To recap, While standby letter of credit and demand guarantees may seem similar at first glance, the differences in structure, terms, and legal recourse can have a major impact on risk management in international transactions. Understanding whether you are dealing with the confirmed standby letter of credit or an indirect counter guarantee structure is essential for ensuring you have the right protection in place. Thank you for watching. In our next video, we will dive deeper into the pros and cons of these structures and how businesses can choose the right instrument for their transaction. Don't forget to like, subscribe, and leave your comment below if you have any questions or if there is any specific topic you would like to be uncovered.